Ever look at all the ways to invest your money and just freeze? Feel a bit overwhelmed, maybe.
Oh,
Yeah.
absolutely.
Oh.
It's a common thing. The investment world can feel pretty complex.
Especially when you want something safe-ish, but, with some growth potential too.
Exactly. Finding that balance.
Well, today we're doing a deep dive into something that can help with that. Mutual funds.
Good topic. Very relevant for many people.
Yeah, our mission, let's say, is to get clear on what they are, how they function, and maybe why they're a pretty efficient route to diversification for you.
Right. Without needing a finance degree yourself.
Exactly. We've pulled together some good info, so let's unpack the basics.
Let's do it. So at its core, a mutual fund is basically, well, it's a managed pool of money.
A pool.
Yeah, from lots of different investors. And professional managers invest that pooled money into various things, stocks, bonds, you name it.
Okay, so it's like everyone puts money in the pot, and the pros decide the recipe.
Huh, yeah, that's a nice way to put it. And that pooling is really the key to diversification.
Ah, diversification. That sounds important.
It is. Instead of your money riding on just one or two companies, the fund spreads it out. Lots of different investments.
So less risk if one company tanks.
Generally, yes. Historically, spreading investments like this has been a good way to manage overall risk. You're not banking everything on one single bet.
Makes sense. Now, I hear terms like active and index funds thrown around. What's the difference there, really?
Good question. So, active funds have managers actively picking investments, trying to, beat the market average.
Okay, trying to be stars.
Right. But that active management usually means higher fees. Index funds, on the other hand, they just aim to match a specific market index, like the S&P 500.
And they just track the market.
Pretty much. They're not trying to outperform, just mirror. And because of that, their fees are typically, well, lower.
So it's a trade-off. Potential for higher returns with active, maybe, but definitely higher costs.
Exactly. And it's worth noting, historically, many active managers actually struggle to consistently beat their index after you account for their higher fees.
Interesting. Okay, fees. You mentioned fees. That's the expense ratio, right? Can you break that down?
Sure. The expense ratio is just the annual cost of running the fund. It covers the manager's salary, admin costs, all that stuff.
And it's a percentage.
Yep, expressed as a percentage of your investment,
Wow.
and it directly eats into your returns. So definitely something to watch.
Right. Lower is generally better, I assume. So how do you actually, earn money from these things?
Two main ways, typically. Dividends,
Okay.
which are like small payouts from the profits of the companies the fund holds, and capital gains.
Capital gains.
That happens when the fund sells an investment that's gone up in value. They pass that profit on to you, the investor.
Got it. Dividends and capital gains. And how do I know what my share of the fund is worth on any given day? Is that the NAV?
Exactly. NAV, net asset value. It's the fund's price per share.
How's it calculated?
Simple enough, really. They take the total value of everything the fund owns, subtract any liabilities or costs, and then divide by the total number of shares investors hold. Calculated daily.
Okay, daily price tag. Now, what about load versus no load funds? Sounds like jargon.
It kind of is. Load just means there's a sales charge, like a commission. You might pay it when you buy in or sometimes when you sell. Often goes to a broker.
And no load.
No load funds don't have those sales charges. So, more of your initial investment goes straight into the fund itself.
Seems like no load would be preferable then, generally.
For many investors, yes, all else being equal, you avoid that immediate hit.
Okay, so with all these different types, active, index, load, no load, how do you even begin to choose the right one? Feels like we're back to being overwhelmed.
Yeah, it can feel that way, but it really boils down to you. It's personal.
Meaning?
You need to look at the fund's objective. Is it aiming for growth, income, stability, and match that with your financial goals, and crucially, your tolerance for risk?
Right, how much uncertainty you can stomach.
Exactly. It's about finding a fund that fits your personal financial picture and timeline.
Makes sense.
Yeah.
Any tax traps we should be aware of?
Well, not traps necessarily, but implications. Like we said, the dividends and capital gains distributions you receive, they're usually taxable in the year you receive them.
Oh, okay, so need to plan for that.
Yep. Just something to keep in mind for your overall tax situation.
And one last thing, rebalancing. What's that about? Sounds like maintenance.
It kind of is. Rebalancing just means periodically adjusting your investments back to your original plan.
Why would you need to do that?
Because over time, some investments will grow faster than others. Your mix, say 60% stocks, 40% bonds, might drift to 70/30. Rebalancing brings it back in line with your target risk level.
Ah, keeping things on track with your original strategy.
Precisely. Helps manage risk over the long haul.
Okay. So wrapping up, mutual funds seem like they can genuinely help manage that feeling of being overwhelmed, right? Offering diversification, professional eyes managing the money, access to different markets.
Yeah, they can be a really useful tool for a lot of investors. A way to get started or stay diversified without having to pick every single stock or bond yourself.
So maybe a final thought for you listening, thinking about all these aspects, the diversification, the fees, active versus index, your own goals, what kind of fund maybe aligns best with where you are right now financially and why?
That's a great question to ponder. Hopefully this chat gave you a solid starting point for exploring mutual funds further.